Good morning. I was trying to get my camera to work, but it's not appearing to be working for me today. So no picture of me. Um, Good morning, Jim Barlow, OakTree Premium Finance. Today's topic is dissecting the building blocks of Kaizen. I've been thinking about this topic for a long time, thinking how to approach it. And I've had parts of this presentation I put in and put parts taken out, but um, there's some conclusions of mine that maybe they're wrong, some assumptions and whatever, but I'll go forth. If you see something that's wrong, let me know. But I think this could be a very helpful concept to understand the building blocks of Kaizen. So with that, let's get started. The building blocks. I'm probably not the world's best PowerPoint maker, but there's my building blocks I chose to use for today. And I think it'll be fun. The first thing I want to do, kind of before we hit that first building block, is go to a video. The reason is because I think this is almost talking about or skirting around the same topic. This video is called The Next Best Thing. This here is a page of my website, and I call these the top 9. See these 9 here? There's other videos on Kaizen that I've made not the top 9. They're down below in the click for additional resources. But we're going to look at this, the next best thing. So let me go to big screen here and let's get started.
Have you ever wondered why you always seem to miss out on potentially life-changing financial opportunities? Rationalizing your decision with thoughts like, I'm not getting it because I've never heard of it, or it'll never make a profit, or costs are too high. Maybe you didn't understand just how significant the benefits could be using new methods. Or maybe it sounds too good to be true. Perhaps with all the transformation happening in the auto industry, the telecommunications industry, and the financial industry, you didn't feel like you had enough money for it all. Yet you felt if you hadn't missed the opportunity to participate, it could have completely transformed your life. In reality, missing a few stock purchases here and there would not have drastically impacted your financial future. The only true financial transformation has come from the use of leverage. Leverage has been the single most crucial factor in transforming our financial situation, and all of us have access to it. Leverage has transformed how we live, how we get around, and our careers. It's helped provide the opportunity to succeed. Leverage can significantly enhance our lives. Introducing Kaizen. Kaizen provides you an opportunity to combine leverage with a uniquely designed life insurance policy. Once a small portion of your contributions are used to provide the death benefit and access to living benefits, the remainder of your money, plus the leverage dollars, have the potential to earn interest. Any potential gains are locked in annually and compounding tax deferred. Because your cash is not directly invested in the market, it cannot lose money due to declines, making it one of the safest products when using leverage. In fact, you'll never be required to go through a credit approval, sign loan documents, make interest payments, or provide personal guarantees. Leverage has the ability to add up to an additional 3 times more money, providing you with an average of 60 to 100% more in policy benefits, rather than using your money alone. Click the link below, enter your personal details, create your secure username and password, and see the potential enhancement Kaizen can provide you. With Kaizen, you don't have to miss another potentially life-changing opportunity. Let Kaizen help you enhance the protection you provide your loved ones and help transform the way you live your retirement.
All right. Um, is Kaizen a transforming type thing? I think it is. I think it can be a major benefit to a lot of people. Let's dissect it. Let's get going here. Get on the right screen. Okay, the first building block, number one, actually cash value life insurance, also known as whole life, permanent life. There's these tax advantages. Cash value accumulates on a tax deferred basis. The beneficiaries receive life insurance proceeds tax free. In other words, that accumulation was totally not taxed. But policyholders can access this cash value via policy loans without immediate taxation. This is the Internal Revenue Code. So tax-free benefits to the beneficiary and tax-free benefits to the policyholders. This is block number one. This is a lot of stuff, but I think this is kind of the foundation of what you're going to see next. Life insurance, whole life, the first policy was issued in New York by Mutual Life in 1868. And then the National Association of Insurance Commissioners was formed in 1871, right on top of it. This is an association of state insurance commissioners. This is who sets the rules. The life insurance world is really regulated by states, and this association keeps the uniform rules together. 1913, federal income tax began. Life insurance benefits were to be federally tax-free. That was a big deal when it became tax-free and you could borrow from it. The policymakers, our senators, representatives, since 1913 have never talked about making life insurance taxable. I guess they could, but they haven't so far, and I don't think they will. But I put some interesting things here that's happening. In 1971, we had the invention of the microprocessor by Intel, which paved the way to personal computers. 1976 was the introduction of Apple I, personal computer by Apple Computer. This started to change even life insurance. In the 1980s, life insurance policies started to add living benefits to these policies. This became it wasn't just life insurance anymore. Now we have a disability clause. We have long-term care benefits. We have some major benefits as this was added in the 1980s. 1979 was the introduction of universal life insurance by E.F. Hutton. I bought a universal life policy when I worked for E.F. Hutton in 1985. And this was kind of a result of the computer world. Now we could have flexibility, flexible premiums, flexible death benefits, flexibility. The original whole life policies had no flexibility. This was your payment forever. This is how much you're insuring. It was all fixed. But 79, we started to have flexibility. 1981, the IBM personal computer was introduced, a staple of today. 1985, we have the development of graphical user interfaces. I'm not a great computer genius, but this led to Microsoft Windows release. And then in 1990, we had the invention of the World Wide Web, revolutionizing communication, information sharing. Wow, we all carry around a cell phone. It's on my desk. I'll be putting it in my pocket as I leave. These things have allowed life insurance to start changing. the universal life I mentioned in 79, but in 1997, we had an introduction of index universal life, offering cash flows linked to market index performance, which is a big deal. And in 2011, Kaizen was invented by NIW out of Dallas, Texas, where they optimized index universal life and added leverage. There's a little bit of a brief outline, but let's get back to the building blocks. So building block number 2 was these living benefits that was introduced by MetLife in 1997. You had critical illness benefits, chronic illness, this is long-term care type things, terminal illness, cancer, and all these things, permanent disability from accidents. You get to tap a portion of your death benefit, usually 80, 90%, a large amount. So all of a sudden, you've got money for your own needs and your own illnesses and your own disability in your own life. I think this is a big deal. This is the building block number 2. Building block number 3 was this universal life. As I said, introduced by E.F. Hutton in 79. Unlike whole life, which features fixed premiums throughout the insurer's individual life, universal life offered flexibility. Flexibility premiums, actually raising and lowering your death benefit, a lot of different things. The interest rate, the cash flow in universal life policies earned interest typically at a money market type rate. So instead of a 2 or 3 or 4 as in whole life, we had higher rates. And in 79, interest rates were much higher. But this gave flexibility to the insurance world, this universal life. In 1982, the government got involved a little bit, saw something that maybe was too good to be true, and they came out with the Tax Equality Fiscal Responsibility Act, TEFRA. And what they said was, you can't put just lump sums of money into a life insurance policy and have it totally tax-free. What was happening? The wealthy, they were taking a large sum, $10 million in one day, and putting into a life insurance policy. And to be a life insurance policy, if they're putting in 10 million, that means the life insurance was for 10 million, 500,000, 400,000, whatever. And that grew tax deferred, and they could it was tax free to the beneficiaries. And as we mentioned, they could borrow from it. So, wow, the wealthy were putting large amounts into life insurance policies, even though it was just at this time before 1982, just whole life policies with a moderate return. It wasn't index universal life yet. If you put too much, and then 1982, they introduced the concept of modified endowment contracts, saying that if you put too much in all at once, then it's going to be a taxable investment. And notice way down at the bottom, total premiums paid within initial 7 years of the policy were specified. And so that's the rule. The life, if people want this to be tax free today, then whatever they're buying, their age and how much insurance, there's a maximum they can put in per year for the first 7 years. And whenever the federal government takes something away from us, look to see why they did and the benefit there was there, and is it still available? And it is within the 7-year rule. And also, you'll see how that works. I didn't make this a building block, it's a kind of a negative, but a reality you need to be aware of. Building block number 4, index universal life. Introduced, as we've said before, in 1997. Again, it's a permanent life insurance policy, but the death benefit and cash value growth was a little different. This is important to understand. So, premium allocation. Excess premium payments are divided into 2 areas: the general account of the insurance company and the index creating it option. Let's say 90%, 95% is going into the general account. These are the bonds, the mortgages that the insurance company buys. They don't buy stocks. They buy very conservative investments. So the majority of premiums are invested in the insurer's general account. Now the index crediting portion, let's say it's 5%. This is known as the option premium. And with this money, the insurance company with its index universal life buys an option on the stock S&P 500. And they'll say, okay, you can have stock market returns with a cap up to 12%. So if the market does -10, your general account is insuring your money, and the option expired worthless, but you don't lose anything. So you get to participate in a index performance. S&P 500 is a typical one, but there's also participation indexes, which say this is a balanced type fund, and you'll get 200% of this index without any cap. So performance-wise, the index universal life, you could get market returns or maybe market returns plus and no downside. Returns are subject to caps, floors, but no downsides. This is a major building block. Market performance, no downside. So the Kaizen people of the world said, look, tax-free, potentially tax-free benefits, zero downside. Real estate doesn't have that. Potentially upside based on positive growth of a market index. Ooh, we have life insurance with accelerated living benefits. With these strong benefits, why would we not leverage this investment like we do in our homes, like we do when we buy real estate? And the answer was, yeah, why not? So that's where Kaizen was started to be thought of. And here's what they did. Building Kaizen. First, they had to look at these policies and these companies that were willing to work with them, and they worked first to minimize costs. They can't, if this thing is too expensive, it's not going to work. What will advisors, agents, what will they be willing to accept less? What were they willing to forgo? What can we do to reduce costs within this policy? So they did a number of things to do that. I'm not going to give the details today, but then they say, what's the optimal funding? What adhering to the TEPA rules, we've got to do that. What's the optimal one? Is it 7 years? Is it 3, 5, 10, whatever it is? And they started trying lots of different options, doing some hypothetical growth analysis, and discover where they felt was the optimal funding. And then they started designing this so clients would stay with it, not have client funding fatigue. A lot of life insurance policies are dropped. a lot of them, more than 50%. Term policies, more than 95%. So we've got to keep, if people will keep it, will this really work? They then stress tested it for long performances. We're going to show you a chart on stress testing. And then they worked on stress testing the confidence they have on the return they can get versus the loan costs. They've done a lot of things in this area to build Kaizen. And now I'm going to just show you some of the features. We've actually covered the building blocks, and there's just a few, but now we're going to talk about Kaizen. So the way they build it and the bank involved, we're going to be borrowing, leveraging with no interest payments, no loan documents, no credit checks, no personal guarantees, no signature, no collateral. I probably should add that to the list. No collateral. How does it work? They've designed that the optimal strategy is a 10 payments, but the investor, the client, makes 5 annual payments. Actually, with Allianz, we can actually do it with a monthly payment. And the bank that we have involved make about the same 5 annual payments of the same, close to the same amount. And then after 5 years, the bank now assumes your payment you were making and their payment they were making and makes payments through 10 years. And we normally say this is leveraged 3 to 1, which is it'll always be approximately there. This is a little bit right field, but the biggest impact on how much you will have in retirement is the amount you invest, not the rate of return. Myself included as an investment advisor, what was I striving to do? I was always striving to get clients a better return. I found a better strategy that makes a better return. But the rate of return is only 26% of the results you need. It's the amount you invest that's really going to tell the tale of your retirement, the amount you invest. So that's where the bank comes in. We're getting money invested that you wouldn't have. And the results are phenomenal as you keep the policy. Stress testing. They stress tested this from the 1980s, looking over interest rates as they were the highest of any decade, and Kaizen worked. They stress tested for the Great Depression in the 1930s, where lots of years were negative, and it worked. It works in the bad times with the 2 different types of bad times, and it works on the good times. Does it work with as the last year or 2 as interest rates have been going up? Actually works better. I have a video about that. It's not in the top 9, but it actually works better because you have more money for the option premium. So Kaizen becomes a solution to help your retirement gap, your medical gap. When you can tap 80 to 90% for medical uses, the payment gap is only 5 payments. It makes it livable. I like it. Obviously, I like it. How do we use Kaizen? So the number 1 is retirement income. And that's the exact same reason a lot of companies use it as executive or employee benefit. They give them a Kaizen policy. And they either pay half or some or all of it and give them that retirement that they want too. It makes retirement possible for a lot of people. Another use is transferring wealth. There's no better way, I don't think, to transfer wealth to the next generation than not give them a lump sum today, but give them a Kaizen policy that's going to be amazing numbers down the road. You can use it for just your life insurance policy to protect yourself. What a good way, or as infinite banking, or as a fixed income alternative for buy-sell agreements with businesses, for key person protection in businesses. These are the uses of Kaizen. This is a chart that I designed myself. These are my numbers. They will not issue a Kaizen policy after 65. So that's why it's red. And remember the 10 years, 5 years of your payments and 5 years continue to the bank. We really need another 5 years before you start taking income. We need some time for this to grow, to cook, to simmer, whatever you want, analogy you want to use. So if you're right at 50 and the normal, well, I don't know what this 65 retirement thing means. It's certainly not what I want to do. Anyway, 15 and 50 is 65. So I put 50 below as a sweet spot, green. And 51 to 64, it kind of can work. It depends on your objectives and what you're looking for. And if you're in that age bracket, happy to explore it to see if it will work. But there's those same Bennett uses that I've been talking about along the left. The green are business use, the blue are personal use. And there's the transferring wealth gifting strategy. The giver, they have some rules here. If the giver is less than 55, they need to own their own Kaizen. If they're over 55, there's no restrictions. Anyway, there's my suggested ages. I think this, I've never shown this chart, but I think it's an important one. Life insurance costs, a life insurance policy costs a lot in the early years. And yet people don't, they look at this policy at 5, 6, or 7 years. Oh, this is not doing its thing. It's not growing the way I thought it would. No, it can't. You're paying for life insurance policy, the disability, the long-term care in those early years, but down the road, it's going to average 0.46. It's going to be less expensive than managed money. It's going to be less expensive than mutual funds. It'll become less expensive, but not in the early years. That's an important concept to understand. Here is a real annual report on a Kaizen. If you'll notice way up at the top, it says the client name is Grace Barnard. She is one of the founders of Kaizen. This is one of the first policies issued. So you have a good analysis here, but you can get the summary. The 10-year average return on this policy in the internal money was 7.58, and the average loan rate was 3.57. So the spread between the loan and the return has averaged 4.01 from day one when she bought it. And you can look at their payments for 5 years, all the fees and the interest rates paid, the returns. So what's this in the 10th year? You can see how long it's been around, but you can see it's performing. Now that 4.01, they did another stress testing thing. They looked back to the 1930s, from the 1930s to today. And there's never been a 15-year period with the spread less than 2, because we have no downside. So you can't say we guarantee you a spread of 2, but there's never been a 15-year period of time with this spread less than 2. You're going to have individual years where the performance was 0 and you're still paying whatever the interest rate is. That will happen, but your average has never been less than 2. Anyway, there's a statement. So let's summarize these building blocks. There they are. Number 1, accessing cash values tax-free from life insurance. 2, living benefit protection in the 1980s. 3, universal life flexibility. I put in Tefra because it's a game changer. Then number 4, index universal life, where we can get performance with no downside. And then the building block of Kaizen 2011, optimize index universal life and added leverage for greater accumulation. I like this presentation. I hope it's been helpful. As you know, I've talked about our ILIA. This is a website you can have participation in. You need a login and a password. And with this, you can do analysis, estimate my benefits. You can see more videos. You can read up on the left side. You can do lots of things. Usually at this point, I usually do some samples and show you how they work. I'm not going to today. I actually need to make it a shorter webinar. I have a granddaughter flying into the airport this morning. She's been on a mission to Australia and I want to go down and see her. So we're not going to do that. But to have access to this site, I need your phone number, cell phone number, your email address, and your birthday, and of course your name. As you've listened and you'd like to start to learn more, certainly you can call me and we'll talk. But you can also have access to this site and play around with it on your own. I hope this has been a worthwhile webinar today. There's my phone numbers. There's a QR code for information about Kaizen. But I've enjoyed presenting this today, and I hope you have a great day, and we'll talk to you later. Bye.